I think when it comes to evaluating a business or a stock, depending on who you are, you care and you prioritize certain metrics and fundamentals over the other ones, right? There's some people out here where it's all about the debt. Oh my gosh, this company has too much loans. They're highly leveraged and they're just drowning in loans. And I guess that makes sense. It's crucial to take into consideration. And then there's other people out here where when they think about the free cash flow, it makes their nipples absolutely perky. That's all they care about. And then for other people like your bald neighbor, all they care about is their market share in the industry that they operate in. And the truth is, nobody's wrong. They all matter. They're all really important. The point that I'm trying to get across is that there's a million things to look at to determine whether or not a company is solid or if they're bad. But truth be told, to look at everything, dude, that would be way too time consuming. And that's why I have a stock checklist that I'm constantly updating and refining so that I can refer to it to see if a company is worth diving deep into. Because not everybody is worth our attention. And to spend like 5 hours looking through all the financials and fundamentals only to determine that they're ugly is not productive. But if there's a quick cheat sheet that I can refer to that has like the bare minimum standard and the checklist that I can go line by line, and the company is above average in all categories, then we can go to the next step, which is the full analysis. And we do that to cross our T's and dot our I's to decrease the probability that we are investing into a piece of crap. We look at all the financials, the numbers, and the details. That way we can have the confidence to know that what we are investing into is actually a high quality dividend compounder with cheese. And by the way, welcome to the Sausage Fest. Almost every viewer of this YouTube channel is a male, determined by the YouTube demographics data that I have available on the screen. Ooh. But going back to the video, with that in mind, what I wanted to talk about today is the metric that most investors forget to think about when evaluating and assessing a potential investment. And that's the ROIC, the return on invested capital. And as you can see on your screen right now, the best way to sum up the ROIC is it measures how much profit after tax a company earns for every dollar of capital invested into the business. And I highlighted every dollar of capital because I wanted to clear up any confusion in the room. Because I know someone is back there thinking like, what is capital? Is that the revenue? Is that the free cash flow? Okay, no worries, I got you. So when we as investors refer to capital, it's the money that has been put into the company or the business by the shareholders and lenders in order to fund the operations. That's capital. So where does that derive from? What's the source? It comes from shareholder equity on the balance sheet. So money from the shares that are outstanding in the stock market. And then number two is through their loans, bonds, and any debt that they might have. So that together is the capital. So the ROIC measures how much profit that we get from the capital that is already invested into the business. And to me, I think the ROIC is important because it tells us how efficiently a company is utilizing their capital. And the formula to calculate the ROIC is the net operating profit after tax divided by the total invested capital, which is, by the way, what? Those two things? The shareholders' equity plus the debt and the loans. And a high ROI score implies that the business that we're thinking about or looking at has an economic moat. It's a way to tangibly measure if they have pricing power, any competitive advantages, because a high ROIC depicts just that. Now, the minimum ROIC score that we want to see as investors, this is not financial advice, but it has to be at least 5%. The higher, the better. If it's closer to like 15 or 20%, that means the company is more profitable than one that earns a lower score. So to give you an example, let's say that a company has a 20% ROIC. That means they earn 20 cents of profit per dollar of capital invested. So 20 cents per dollar. Whereas if we see something like a 5%, which is our minimum standard, that means they earn 5 cents of profit per capital that's invested. Now, the reason why you want a high ROIC score is because those businesses don't need new capital in order to grow or to expand or to thrive because they make a lot of profit with the money that they already have. They don't need to take on more loans or issue more shares and dilute the shareholders in order to grow. So a high ROIC score is a good thing. That's all we have to know. Now, before we go any further, I wanted to give a shout out to the video sponsor. This video was made possible by the support on Patreon from viewers like you. Shout out to you guys. As a matter of fact, because of y'all believing in me and supporting me, I'm in the market to buy a new bicycle. And I narrowed it down to what I'm gonna get. I just have to go to the store and hand over the money. I'm getting a Dutch bike. And in Japan, we call it a mamachari. And it's essentially a city commuter bicycle, because right now I've been using a road bike, but it doesn't have any of the bells and whistles like a pannier rack, a basket. And the bicycle that I have right now, I think I'm gonna save for rainy days. That way I don't rust my new commuter bicycle. But yeah, I'm really thankful for you guys, because now I'm able to upgrade to an actual commuter bicycle rather than using one that's not designed to commute, to get around town and to make my way to my part-time job. And by the way, speaking of a Dutch bike, come to find out, last week, I didn't know this because I'm an ignorant American. However, in the Netherlands, apparently there's something called a tikkie culture. Meaning, if you go over to your friend's house and you guys are having dinner, at the end of that meal, the host, that friend or the family or relative member, they're gonna send you a Venmo or a receipt for how much you need to pay for the meal that you just ate. And to take it a step further, let's say you and your friends go out to eat, it's McDonald's. And one guy has like a Big Mac and a side of fries, and then this guy just orders a McFlurry. And let's say the guy with the McFlurry is like, hey, can I have one French fry? Well then, this is what happens with the tikkie culture in the Netherlands, apparently. Okay, I'm ignorant, I don't know if this is true or not. He's gonna charge that friend for that one fry. And depending on how many fries there are, assuming that there's 100 pieces of French fries and he eats just one, he's gonna send them a bill for 1 penny. Now what I'm saying is there's being stingy and cheap, and then there's the Netherlands tikkie culture. Can someone please tell me if this is true or not? Because if it is, dude, that is just, my goodness. Because as a Korean American, hospitality is everything. When someone comes over to your house, we treat them like royalty. We don't charge them for anything. And as a matter of fact, when you go out to eat, the biggest argument amongst the party is gonna be, I want to pay the bill. Everybody wants to pay the bill. So that's the kind of culture that I am familiar with. So to hear about another culture that's like, if anybody takes any one of my fries, I'm charging you for it, it's like, it takes me aback. I'm like, dude, that's wild. Okie dokie, so getting back to the video, let's do a working example with TROW. By the way, shout out to Adam Kahn for putting this company back onto my map. He talked about it in one of his recent videos, and it's a company that I used to keep a close eye on, but during the pandemic, they had this absurd run up in their stock price valuation to the point where I just deleted them from my watch list, and it's been like 3 or 4 years since I last paid attention to them. So Rowe Price Group, ticker symbol TROW. So they're made up of a bunch of financial planners and financial advisors that are taking care of your money in investments for retirement planning. They also do mutual funds and asset management for commercial clients, not just rich, the millionaire consumers. And they make their money from all of the fees that they charge for their products and services and investment platform. So as of right now, they're currently trading for about $86 a share. Depending on when you watch this, it might go a little higher or a little lower. Their dividend yield right now is what? 5.9%. So on surface value, I'm like, okay, that looks pretty darn juicy. And if we zoom out, we take a look at their past 365 days, we can see that they're hovering around their lowest price that they've been for the past 1 year. And if we zoom out 5 years in 2021, this is exactly when I decided to delete TROW. I was like, okay, this is ridiculous. They should never be near 150, let alone 216, what is this? $220 a share. I just deleted them and forgot about them. And now they're finally at this valley, their lows. We're on surface level, a high dividend yield. Their valuation is finally undervalued. TROW has got my attention, and let's go ahead and apply the quick cheat sheet to see whether or not they're worth diving deep into. So the first thing that we're gonna do, the thing that we just learned today, is the ROIC. And as of right now, it's currently 17.3%, according to the website Finance Charts. But one thing that I do want to call out is even though that's a really good number, it's above 10%. And as a refresher, 5% is the minimum standard. So being 17% is really good, right? However, when we think about the past 20 years, on average, their ROIC was hovering around 27%. So what I'm saying is that they're not utilizing their capital as efficiently like they did in the past. And I think that's because they're probably transitioning and digitalizing all of their platforms and offerings and services. Because I think even like in 1999 or 2001, almost everything was offline, right? We had to trade our stocks by paying like $8.50 commission fees, which, by the way, thank God I'm an American, because almost every investment platform offers free trading. I can't imagine having to pay $20, let alone, $8.50 to make one transaction. Dude, that would rub me the wrong way. I'd be like, dude, that's crazy. All that to say, even as recently as 5 years ago, the average ROIC was almost 25%. So what I'm saying is, in the past 3 years or so, it's just been eroding and just been declining. So something is happening. TROW is not as profitable as they once were, and I'm not sure why. Like, we have to look at their investor presentation, tune into one of their most recent earnings calls to see what their leadership team is saying. But I'm assuming it's that they're spending a lot of CapEx and a lot of money on digitalizing their platform and offerings. I guess that would make the most sense to my small pea brain that's a little smooth. Because I feel like even as far back as 25 or 30 years ago, most people that were investing into the stock market at the consumer level probably relied on financial advisors to do all of the heavy lifting for them, to see like what's good, what's bad, and they pulled the trigger and said, hey, at the end of the year, this is the outcome, this is the result. Your portfolio is up by 10% year over year, right? But now that it's 2025, if you're watching this video, I feel like most of us, we don't utilize a financial advisor or a planner. We have the cojones to place our own bets, or I guess our strategic investments into high quality compounders like Main Street Capital, Ares Capital, Hershey, or even Microsoft. We do it ourselves. So their business model going forward, I don't know, but what am I saying? This is not a deep dive video. So right now, present tense, the ROIC looks pretty darn good, but I don't like the trend that I'm seeing on how it's declining year over year. But just for fun, let's go over the other checklist items, and that in the future, if someone asks me like, hey Amos, what's a quick cheat sheet that I can reference to see if a company's worth our attention or not that takes less than 2 minutes, I'll just link them to this video. So the next thing that we like to look at as investors is the top line. This is what we refer to as the revenue. We need to see whether or not the business is growing, because ultimately the gross sales and the revenue tells us if they're doing just that. If the revenue is declining year over year, then it tells us that they're losing market share, they're losing pricing power, or the consumers are taking their business elsewhere. Now, in the case of TROW, let's just look at it visually. It looks like their revenue is pretty plateaued. In 2020, it was $6.2 billion. And as of right now, it's $7 billion. So it is going in the right trend. But what I want to call out is in 2021, it used to be $7.6 billion. So why couldn't they keep that trend and that momentum and go up the following year? Rather, it drops by negative 15% year over year. And then it stayed relatively flat year over year from 2022 to 2023. However, they were able to rebound and recover and bounce their revenue in the right direction by 9.8%. So overall, I would say their revenue and their trend is kind of average. It's not the greatest thing in the world, but it's also not ugly. However, it's probably like a C-. It's a slightly below average because we do want to see it at least steady or maintained and growing at a snail pace. But what's happening here is that it's kind of volatile, right? It goes up, it goes down, it goes up, goes down. But in the grand scheme of things, in 5 years from start to finish, it did go in the right direction. So we'll just give them a C-. Now, the next thing that I like to look at is their free cash flow per share, and we break it down by the share level. That way, it's easier for us to compare company A to company B, and it takes into account whether or not they're diluting the shareholders with the shares that are outstanding. You do not want to see a company constantly issuing new shares. That is a no-no, and it's ugly, and it's kind of like when we were growing up, your best friend having a crush on your girlfriend. Like, dude, what is wrong with you? Just find yourself your own girl. Like, why do you have to have a crush on my own girlfriend. But I digress. The free cash flow is really important because it's the true cash flow that's pouring into the company that finances and pays for the dividends that are paid out. Now, for the purposes of this cheat sheet, it's not financial advice. What we want to see is a free cash flow per share where it's pretty steady or growing in the right direction, which is up and to the right. Now, in the case of TROW, what I see is that that is certainly not the case. It is absolutely volatile, which tells me that their cash flow is not predictable, it's not reliable, and it's not constant. Sometimes it's good and sometimes it's bad. So once again, I'm gonna give them a C- for their free cash flow per share. This is not what you want to see. However, the reason why it's not a D or an F is because they're at least positive free cash flow. I'm telling you right now, there's a ton of companies that people think are cute or beautiful on the surface level, but once you start looking at their numbers, dude, they're unprofitable. They're negative free cash flow. They're drowning in debt and they're ugly. On the other hand, TROW at least has positive free cash flow, so we're gonna give them that. And by the way, I wanna backtrack to what I said about issuing more shares is terrible. That's not always the case. When we take into account REITs or BDCs, that's exactly how they grow, and that's because they have to issue at least 90% of their earnings out as dividends. So if you only have 10% of earnings left over, dude, after you pay for your staff, your marketing, and all the other expenses and overhead costs that you have, you can't really grow or expand your business or territory or buy more real estate. So REITs and BDCs by design issue more shares, and it's not something to be scared about. It's how they raise capital. Okay, so moving on to the next thing is their dividend growth rate, and I guess their dividend profile in general, because the older that I get, the more that I emphasize and learning to appreciate the dividend, because when you think about it, that dividend cannot be paid out if the company is crappy, if they're struggling or drowning, like help us, we can't make enough money. If the company is ass backwards, they're not going to be able to grow their dividend, let alone pay for one. It's the consequence, the result, and the output of a company crushing it in all of their operations and financials. And that's why the older that I get, the more I'm like, damn, dude, when I see an impressive dividend profile, the more I sit back and I'm like, dropping a deuce, and I sit on the toilet and I ponder, I'm like, dude, this is actually a really good company based on just the dividend profile. Remember what I said in the introduction? Some people, that's all they care about. And I'm starting to see the light. I'm like, actually, if that's all you see and think about, it's not terrible, right? There's other stuff that you should also look at, but if you weigh the decision-making process heavily towards the dividend profile, it's not the worst idea in the world. That's not financial advice. You do also want to take into account the free cash flow, the revenue, the net income, and all of the other factors and considerations, but the dividend is super important. That's what I'm trying to say. So right now, 5.9% dividend yield. Is it sustainable? Yes. 55% of their earnings per share finances the dividends per share, which is $5.08. Pretty good. I want to see a number here less than 80%, and it's far below it, so it's safe for now. And they're growing it for the past 39 years, so a little older than how old I am. And then their dividend growth rate, how much is this number growing by year over year, is 1.8%. Not good. However, this is good. So maybe they outweigh each other. They balance each other out. The growth rate is not the greatest, but the yield is pretty darn juicy. So seeing this number right here, it tells me a lot. Like, wow, I'm closer to 40 than I am to 30. But also, this company has been crushing it and has been expanding and growing for the past 39 years. Because I'm telling you right now, there's a ton of companies that have cut, reduced, or got rid of their dividend altogether, at least in the last 10 years. So to see a number like this is actually pretty darn impressive. That means they were growing their dividend through the financial Great Recession, the pandemic sell-off, the 2000 dot-com bubble crash. They've been growing it through all of the highs and the lows. That's something to take into account. So I think looking at their dividend profile, I think for me, this is a B+. You might be like, Amos, why aren't they A or an S tier? Because, my friend, it's this right here. The dividend growth rate has to at least meet or exceed the rate of inflation. That way we know that our dividend payout is keeping up with inflation. That way when we use that dividend income or that passive income to however you see fit, whether it's to pay for your OnlyFans subscription account or to buy a new pair of shoes at Costco, at least you know that your dollar is worth that dollar today. Because an economic lesson here, $100 today is worth a lot less than it was 20 years ago. 20 years ago, when you had $100, it would be worth more. So $100 in 2005 is worth more than $100 in 2025. Okay, so moving on to the last one is to assess their debt situation. Is it manageable? Are they drowning? And to do that, there's so many different ways, right? My favorite flavor is salt and caramel. Dude, that ice cream flavor slaps. My second favorite is probably matcha. In Japan, I feel like that's the crowd favorite. Everybody gets the green tea flavored ice cream. But back in the States, dude, salt and caramel ice cream, oh, all day long. I could literally gain 10 pounds by the end of the week just by eating ice cream. What I like to do is look at their debt to EBITDA ratio. And to do that, we need to find out their total debt by looking at their balance sheet. And as of right now, it's $337 million, which is not a lot, especially in comparison to their market cap of $19 billion. But I digress. And we're going to compare that to the EBITDA, the earnings before interest, taxes, depreciation, amortization, and that is $2.8 billion. So I can tell you right now, that's going to be a very small ratio. The smaller the ratio, the better it is. The golden standard is 3 and below. So taking T. Rowe's total debt and dividing it by their EBITDA, it spits out a ratio of 0.12. I don't think you guys understand. That is so ridiculously good. To see anything below 1, dude, that's only seen in companies like Google, Microsoft, and maybe like Apple. But to see a 0.12, it tells me all else being equal, it would take T. Rowe 0.12 years, which is probably like a month and a half, to pay off all of their debt and loans that they have on their books based on their current EBITDA, if nothing else were to change. So it tells me their loans and their debt absolutely manageable, and if things were to get sour and they hit some setbacks, they should be okay. And to verify that, what we look at is their balance sheet and their cash and cash equivalents on hand, their liquidity, $2.6 billion, and remember, $233 million of total debt, or something like that. What was it? $337 million of total debt. 2, how much cash did they have? $2.6 billion. So, what do you guys think? Should we do a deep dive into T. Rowe to figure out if they're worth investing into or not? I mean, I'm gonna be honest with you, their dividend profile is like screaming at me. It's like pinching the left nipple, and I'm like, ah! But what's holding me back is their revenue is just inconsistent and all over the place, just like their free cash flow situation. So I don't know. Anyways, I hope you guys learned a thing or two in this video. And as a friendly reminder, I hate that type of email from HR. Just shut up. Okay? But anyways, as a friendly reminder, the folks on Patreon get exclusive content and a shout out on the channel. So if you're able to, please hop on over to the Patreon. And even if you choose not to, I love you guys. Stay safe. Good luck in the stock market. And I'll talk to you guys really soon. Peace.